Here we go. It's time for the August ADP payroll report. Steve Leisman's here. Steve.
Thank you. 15. Yes, it is. 54,000 ADP, the private payroll company, estimating that private payrolls around the country rose by 54,000. That is against an estimate of 75,000. So a little bit under. Good sector, 13. Interesting number there. Services, 42, not so strong. And there's the non-farm payroll estimate, 75 for both government and the private sector for Friday. So we'll see if there's an adjustment. It's in and around. Small business, okay, up 12,000 relative to the total there. Medium up 25, and large business up 18. It's been large businesses leading the way, so it's interesting to see small business catching up here. But this is where it gets interesting. Leisure and hospitality, we've seen that up 50. Construction up 16. And I really just want to go right to the education and health services, which is, by our estimate, the 5th month in a row we've seen this decline. That had been a perennial stalwart source of job growth, not anymore. And there's trade, transportation, and utilities down 17. I'm interested in that because the tariffs might be reducing some of the goods flow, and we'll see what happens, whether or not that leads to layoffs in that sector. Job stayers up 4.4% in terms of their wages. So that's pretty good. And my talk with Waller yesterday suggested that, as long as wages remain okay, then you've got pretty good demand in the jobs. But I'll just tell you, before we get to our fantastic guest that we have here, Neela Richardson, yesterday's Beige Book was a real eye-opener for me. Really a weak report. It wasn't quite the report we've seen ahead of recessions, but it was spoke of an economy that's really at stall speed right now. There was no hiring going on, no growth, very limited consumer spending. Y'all should go read the first 2 pages of that. It was really...
First time anybody's ever told me that.
What's that?
It's the first time anybody's ever told me to go read the first 2 pages of the Beige Book.
Well, I'm saving you reading the 80 pages of it.
But the first 2 pages lay out an economy.
They lay out an economy at stall speed, little economic activity. 4 districts had modest growth. And then the Challenger report this morning, layoffs up 39%. Adding pharmaceuticals and finance to the sectors that we're seeing layoffs. So
Steve, have you seen it?
I ended up with more concern about the economy after yesterday's data and this morning's challenge.
Is there anything to notion that the falling participation rate is masking a much higher
it could be. Yes, it could. Yes, it could.
What would it be if you put everything back in and you take the same participation?
Did you just talk to Kyle Bass?
No.
Because I ran into him outside and we were having.
We just had him on the show.
But he didn't give you that number?
No.
He says it's closer to 5%. I have not personally calculated it, but he says it would be quite a bit higher.
No, I didn't talk to him about that. I have a brain, sort of, and a heart.
You don't have
okay, I can think of these things on myself, right, Neela?
I perfectly believe you can.
Neela Richardson is here. She is the ADP chief economist. Neela, does this report that you've seen with ADP play into what Steve was just talking about? Does this describe an economy that's in stall speed as far as the data you see?
I think it's been in stasis for about a year now. But we have to look at the broader context. This is an economy that was kind of whipsawed by the Great Resignation. A lot of people are pretty happy where they are, and they're staying put. So
happy where they are at work or happy where they are unemployed?
Employed. But also, this is, firm behavior, employer behavior has changed quite a bit since the pandemic, and you can see it in the hours worked. Right now, average hours is about 2 hours less a week, according to ADP payroll data, than it was before the pandemic. That's consistent with a hiring pattern where you're keeping people on payroll, but they're working fewer hours. Before you cut a job, you'll cut an hour.
Right.
And so what we're seeing is maybe an underemployed worker as opposed to an unemployed worker, which is a meaningful difference. It's also easier to add hours when things pick up. So the flexibility we're seeing now is in hours worked, not just in growing and shrinking your headcount. That's new.
That's really interesting. What Steve pointed to, this idea of education and health services suddenly being a weaker sector after years and years of being this powerhouse, what's happening there?
There's a lot of things happening in healthcare. Whether it is labor shortages, we're seeing that. We're seeing an aging demographic take root in that industry. So if you look at the average age of nurses and doctors and healthcare aides, it's going up. You're seeing that retiree segment tenure shorten because people are leaving the field post-pandemic. Immigration is going to have a huge factor in a sector like healthcare or construction.
Those are all supply
Those
side
are supply
issues, not
issues.
demand side. So the demand's still there, but they can't find workers for those.
So part of it is supply. Part of it is having the dollars to hire. A lot of that sector is built in on grant money. If that grant money dries up in education and healthcare, you can't get. You can't hire in the same way that you may have been able to
for education
when the
aides along those for aides in the classroom or different things.
Yeah, aides or postdocs in universities. So all of this is playing out into a weaker education and healthcare number that we've been tracking for quite a while. This is not new. For ADP payroll data, it is a distinction with the BLS data. We have seen weaker healthcare growth for the better part of a year.
Is that an argument for the Fed to cut rates, and do you think they're late?
You know, I think they have a muddled decision. I've been attending Jackson Hole with Steve for the past few years, and what's been clear to me in that evolution of the discussion there is that being a central banker is harder now than it's ever been. There's no clear-cut, easy choices, regardless where you are in the world, because you're dealing with all of these mega trends, from AI disruptions to a cautious consumer that is muscling through price increases and higher price levels, but is still cautious about it. And then you have AI disruptions and aging workforce. So all of this is making monetary policy difficult to do. There's no clear answers, even going into the next FOMC.
Becky, I just want a minute here. Yeah. There was a little footnote in a Governor Waller speech in which he talked about getting ADP data and watching it closely and drawing a lot of his conclusions over what's happening in the job market from ADP. And I want to give you some data here because year to date, ADP is reporting 587,000 jobs with only a couple of little revisions. The government's reporting 597,000 jobs with massive revisions. Over a 12-month period, ADP and the BLS, the difference is 82,000. So my point is that this data series has done,
and it's right, and it's done a government numbers.
I don't know how to make money with it. That's the problem, because the mousetrap that you want to invent is the one that predicts the wrong number that will be reported by the BLS. This doesn't do that. So if somebody out there knows how to make money with a more accurate number, I don't know how to do that, but I just know if you want an idea of what's going on in the job market, I don't think you can afford to miss this data. I'm not saying it's the be-all and end-all. It's 20%. It's actual data, not estimate.
Right.
But we track it, and it's at one of the lowest right now differences over a 3-month absolute average that we've seen in quite a while. And I just want people to be aware of that. And again, I don't know how to trade on it, but it's good data.